Good afternoon all, great pleasure to be here. I see that lunch was more attractive than the panel, but what can we do? Hard to get everyone back in here. My name is Glenn Silverman. I've been in the industry for well over 30 years. Won't go through my entire history, but investment strategist at Rescura. I've largely been involved in the more listed space, so for me too, delighted to be speaking to some experts in the unlisted space. We've got an exciting lineup of panelists here. They've all got a story to tell. We've done a little bit of prep ahead of this, and I think there's a relevant and exciting perspective they can give you. I've decided on a format as follows. I'm going to decide who I wish to chat first, give each one about 5 to 6 minutes just to introduce themselves, just in terms of their own personal background very quickly, but I think it does set the scene. I think it is important. And then just to talk about kind of the things that they think are most relevant, some of the key or pertinent aspects that we're going to touch on a little bit later. I'm hoping in terms of scope that we can be very broad. So we have experts from overseas, from Schroders, so we want to talk about global private equity, we want to talk about African private equity, and obviously South Africa as well. These are interesting times. That's a Chinese curse. It's not and it feels like that. Volatility, uncertainty. We've come through a COVID period. We have high levels of inflation. We have high levels of interest rates. In the States, we have banking crises. We have Credit Suisse get into trouble. Violent currency moves. There's a lot going on. And we're going to try to touch on many of those different themes and the impact of those on the asset class that we're talking about now. You're well aware of the fact that you can send questions through. We're going to try and leave a bit of space at the end, but it does depend a little bit on how the session goes, because there's a lot to cover. I've also said to panelists that I want a fairly robust debate. I'm very happy that they can agree and disagree. They may not punch one another, but they certainly can challenge one another. And I may intervene if I feel that the panelists are going into too much detail. So please forgive me if I do. I want to try to keep it fairly high level and then aim for width rather than depth. So that's really kind of setting the scene. And I thought to take a very global perspective, it'd be useful to start with Benjamin at the end there, who can give us a bit of a sense of himself and the global private equity environment.
Perfect. Thank you very much for the intro, and very warm welcome from my side. It's a real pleasure to be here after a long period where it was really hard to travel, and especially to that wonderful country, so very happy to be here. As a personal introduction, I'm Benjamin Alt. I'm 15 years with Schroders Capital. Most of the time there, I was a senior member of our European team. We're in charge of the German-speaking countries, Nordics, and Central Eastern Europe. Roughly 3 years ago, my role changed, and I moved out of the European team more into a global role. And today, I'm in charge of all our global pools. And I'm also the lead portfolio manager for our semi-liquid fund, which is a 1.2 billion fund, and I have the pleasure, I think, to talk more about that later on stage. As a firm, Schroders Capital, we roughly manage 90 billion in assets under management. In the alternative space, on the private equity side, it's roughly 17 billion. We do that with 50 investment professionals globally. We have our investment professionals on the ground for the different strategies, which is particularly important to us because we are a real specialist for the lower mid-market. And the lower mid-market for us means like really fund managers smaller than $2 billion US dollar, often $1 billion US dollar, investing actually in companies, let's say 50 to 250 million enterprise value. This is where we are most active in. This is also the segment that we strongly believe in, and we come to that in more detail later. And what we absolutely like is specialization. So doing the same thing in a very good way again and again, we think is the way to really get to a good alpha performance. We are, I see us a bit more on the value side as investors. Our investor base is global, many institutional investors, but we're breaking that up also now with our new semi-liquid fund families, where we go more also towards the private investors. That's a short introduction.
Give us a little bit of perspective just in terms of your view of the global environment.
Sure. I mean, it is a tough environment, right? And we just talked before. We have seen probably the longest period of growth, of almost debt for free. a very good environment, a very favorable environment for private equity, but not only for private equity, for I think investing in general. And when after such a long period, it suddenly comes to an end, there is immediately a doom scenario. And I think that all started very dramatically in March 2020, when we all went into lockdown, and no one really knew what's going to happen, and not on the private equity side, but also in any other asset class. For us on the private equity side and the private equity market, I think what happens in such a shock situation is often a bit of a standstill. And we saw that in 2020, maybe for 2-3 months, but then surprisingly enough, after 1 quarter roughly, activity came back. And I think a bit of a refocus started there. It started maybe a bit earlier, but was then even more pressing, I think, on a global basis, especially in the Western world, US and Europe, from a buyout perspective, a more of a focus towards the asset-light businesses, non-cyclical business, mission-critical business. So everything that you can take that is not necessarily very cyclical, because everyone tried to avoid the risk on a deal level because the environment was risky enough. And that was clearly push in that direction, and people stick to that. I think over the last 3 years, this is still something that we find attractive, but the overall market or those segments attract a lot of capital, be it healthcare, be it software, B2B, like really the more kind of recurring business models, right? Not so much project driven, because that's the first thing that gets delayed, postponed or canceled, and then you have the issue, right? The Asian market, on the other hand, is much more characterized by growth investing. So it's not necessarily a great buyout space, let's say the main markets like India and China that we are active in. And there the focus is mainly around healthcare, technology, and consumer. If you want to, in our view, build kind of a global portfolio and have good diversification from your Asia part of the portfolio, you want to have it totally detached from any kind of Western dynamics. My favorite example is we have an online platform where you can book a doctor appointment in China. So if the US is in a recession, you don't care if you need a doctor in China, you just book it there, right? So there's absolutely no link to each other. And we have seen that quite heavily during COVID, because when China went into lockdown, I think it was, or part of it, in December, January, I mean, we in Europe still went to a conference with a couple of thousand of people, a super return in Berlin, and people talked about COVID, but no one would have expected that effect. When we went in lockdown in March, April, China was back. And China was very attractive then in 2020, 21. But then what we have now is that very difficult geopolitical situation with the US that shied away a lot of investors from China. So we see now on the Asian side a strong move from China towards India. India seems to be a bit like everyone's darling at the moment, very neutral in the overall situation, but from a private equity market point of view, they delivered excellent performance and very attractive deal flow over the last years. I think they would just have to be careful now that it's not pricing is going through the roof, because so much demand is going there. So this is a bit kind of the three main parts where we are active in, and we can hopefully go into more detail later.
Thank you, Benjamin. Chumani, I'd love you to give a bit of your background on yourself and obviously talk about the South African private equity market. But I know you've also recently returned from Cairo. You're at an exciting conference, so maybe a bit of the African perspective as well.
Sure, Glenn, thank you. Yeah, I'm also excited to be here, by the way. It's my first time being in this alternatives investment forum, and I think it's just coming at the right time. Obviously, there's a lot of volatility in the market, and you know, when it comes to alternatives, that's why it's there. It is to diversify away from that volatility. And in private equity specifically, you know, it's for me, it's such a powerful ownership model for times like this. So, you know, we're very active in this space. Just a bit of our business of Mutual Private Equity. We've been around for 23 years now. We've deployed more than 12 billion in 34 transactions across various industries, various cycles. You know, we've just recently deployed our fifth fund. And, we're in the market now for our sixth fund. So we've seen how things have evolved in the South African landscape. And I must say, for me, again, I do come back to say, the private equity model is almost a model we must encourage actively. For asset owners out there, particularly for times like this. And, just as you say, Glenn, coming out of Cairo, it's been interesting how over the last 10 years, the global situation in the US, Europe, you could, make returns quite easily, very low interest rates. And here in South Africa and in Africa, I think the last 10 years have been challenging, more so in Africa, with also currency weakness. I think some of the key themes that played out in our South African environment were obviously, I think throughout the state capture years. Put it this way, over the last 23 years, from 2000 right up to 2015, the private equity returns in South Africa had comfortably outperformed listed for 15 years plus. It was literally these 8 years where we dealt with state capture, and the effect of state capture is obviously, investment strike from foreign investors that also then talks to access to potential buyers for exits, so inability to exit, and obviously in a low growth environment. So a lot of the guys, or a lot of portfolios out there, just struggling to exit because you literally couldn't exit for value. I think that is now behind us, which is great. But unfortunately, what it has done is, from a fundraising market perspective, it's made it incredibly difficult. People sit there and they obviously look at the history. And what we encourage them is, guys, that is behind us. And actually, you've got to look at actually the opportunity going forward. And in a nutshell, for us, again, just coming out of Cairo, we made the point there, South Africa is very much blessed with high quality businesses, very talented entrepreneurs. We've been working with them for 20 years plus. And also our market, even though it might be a low growth market, there are very much structural opportunities in the market. So we typically invest behind tailwinds. Our slogan is, you find the right industry, right business, right management team at the right price. And it's the market for doing that. So this topic here, having powder dry in this market, is exactly how you want to play the market, And then lastly, some of these businesses, because of all this volatility, it obviously translates into pricing. Very attractive price points we feel. And of course, that's what you want in a market like this, to be able to buy well so that you can deal with these volatilities. And then just coming back to Cairo, I think my takeaway, Glenn, was our African GP players, they also, were affected by this whole phenomenon, but their main issue there was currency weakness, right across. And also, with these markets typically not diversified. So very much sometimes resource-based, and of course, that creates even more volatility, which also translates into poor returns, inability to exit, and inability to raise funding. So that still needs to play out, we feel. But I think, again, the person who does have access to capital is in a sweet spot. And for me, it's almost our duty, to encourage people to come back and say, this is what happened. It was very much unique to that environment. Add COVID, add COVID and all of that. But going forward, there is still very much, opportunity to generate significant returns. Whilst, by the way, being able to, influence positively, make impact. Which again, I think private equity as a model as an ownership model has proven itself time and time again to be quite powerful in that regard. As I say, I mean, I've been involved for 17, 18 years, and I've literally seen it, how businesses have been transformed, across demographics, gender, impact on society, bursaries, tick, 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 tick. And so for me, I'm quite excited about the asset class. I'm quite excited that it's going to continue just to grow. Yeah, I'll leave it at that.
Chimani, thank you. That's great. Some exciting aspects, but clearly some challenges as well. We're going to come back to all of those a bit later. Mike, you and I have crossed paths many times over our career. We're debating whether we've been around too long and we know too many people, etc. So maybe, obviously, a little bit of your background would be useful, but just your sense of kind of getting to where we are now. We've come through COVID, we've come, through some challenging times. Your sense of the private equity space.
Thanks, Glenn. So just a quick introduction for myself. My name is Mike Adsetts. I'm the Acting Chief Investment Officer at Momentum Investments. This month is actually my 15th anniversary within Momentum. I mean, we'd love to change our name. So it's same business, a couple of name changes. Prior to that, I had a very brief stint at Old Mutual. And then the other big part of my career was at Alexander Forbes, where I was there for 10 years. So in terms of what we do at Momentum Investments, we manage the assets both internally and externally for a life company and for pension fund clients. So there's close proximity to a life company balance sheet, which has inherent advantages and disadvantages. And in terms of the alternatives landscape, there's a lot of natural advantages that you can have with being close to a life company in terms of longer term capital, patient capital. So it brings you into the alternatives complex. What I'm seeing at the moment in our private equity programs, but our alternative asset programs in general, our private equity programs have been a combination of closed and open-ended funds and hybrid funds, so primaries, secondaries, co-investments, and so forth. What we're seeing at the moment in the market is there's good opportunities, but there's a massive demand for liquidity in the market. So just in terms of some of the liquidity drains that we've seen in the market is there's Regulation 28 that's allowing you to offshore up to 45% of your assets, which is a potential risk in the space. You've got the two-pot system coming down with enhanced need for liquidity, and you've got member choice funds where members can enter and exit. So in the context of a demand for high liquidity, where you can take illiquid assets, you get good advantages because especially in the secondaries market, when there's desperation to get liquidity, I was listening to the panelists a little bit earlier about, is liquidity a premium or is it a discount? If you're in a liquidity squeeze, it quickly becomes a discount. If you can take a long-term view and you can hold investments to maturity, you can harness some upside on that. So what we also seen is that the nature of private equity deals that are coming across our table are changing a little bit. So through COVID, a lot of the private equity programs and investments that were South Africa specific focused went through a torrid time. The local economy was in a very difficult shape. We saw that reflected in valuations. With the opening up of the economy, it has got better, but definitely where we've seen a lot more opportunities in the energy complex. So the energy deals, not government energy deals. Earlier we saw a slide on the reduction of equity returns in government-backed energy deals with the different bid windows, but a lot more in the private space. So self-generation companies that want to put in their own generation capacity, those are the kinds of deals that are giving us good upside at the moment or look attractive. And the other one that's also quite interesting is with the work from home environment and a lot more changing in our ways of work, technology, fintech, rolling out fiber, those kind of are the deals that we've seen good upside. So The benefit of being a custodian of a balance sheet is you can actually see what comes into favor, what doesn't come into favor. You can transition between them. So we've got private equity programs. We think infrastructure, especially equity infrastructure, is a place to be when you bring the private element. So we're launching, or we have launched infrastructure funds focused on energy, social infrastructure that Mutlatsi spoke about a little bit earlier, and diversified infrastructure where there's water, infrastructure, logistics type projects. So if you've got the ability to take longer term views and stick through the tough times, because there's going to be tough times, there's good investments to be had, but liquidity is at a premium at the moment.
Guys, thank you. I was deciding kind of where I should start and where I'm going to start at the end, the exit. Jumani, you touched on it a bit, and Mike, you've alluded to as well, the difficulty of exiting. We have a JSE where we've had more delistings than listings, can't think of a decent listing for a long period of time, etc. That would be a natural source of exiting. Just talk about you've got this book, you've built up, a sizable book. How do you exit? Where do you exit? What does that environment look like now? Because, sorry, it all looks very good until you get to the end, but if you can't exit, it's not worth anything.
Yeah, no, exit is the name of the game. Yeah, so we've exited, as I said, 24 assets over the years. And our most recent exit is, at least a material one, it was Consol, which we did last year. And, that was quite an interesting journey for us. We had invested in 2007. An amazing business, strategic, only one of its kind in the whole continent. And we were gearing ourselves to exit in the 2015 era, But the onset of state capture started. If you'll recall Nenegate, the 3 changes in ministers, the downgrades that we experienced at the time. And an asset like that, you can only sell to a foreign strategic, or listed. So, and we tried to list it twice, and that didn't work out well because, if you don't have options and you're going to go and try to list, your Cape Town asset managers, they'll take you out. I say that, So that didn't work out. We actually had to pull a listing, and because we knew we had a business that was quite valuable, strategic, and somebody is going to pay strategic premium. Fast forward 3 years down the line when things started to open. Obviously there was a change in the administration, and things started to look up again, and along came ADA at the time, and they paid a huge price. I mean, it's public knowledge, 17 billion rand of enterprise value, which was like, a landmark for our private sector industry. So that just showed you that, for me, first rule of exiting, make sure whilst you could, assessing a deal up front, that you're buying something of value, something that people will want to buy one day. And then all you're going to do, you're going to have to it's going to be a timing thing, Obviously, you want to add value to your business and make sure it's a much stronger business than you left it at. In our case, for instance, Consol. We bought a South African business that then we took into Nigeria, into Kenya, into Ethiopia. And that's ultimately what became attractive to this player, is they saw this business as a platform for Africa. You know what I mean? So I think, Glenn, for me, certainly our experience is, as you say, exits is the name of the game. It's something that you want to put a lot of thought into whilst making the investment. Knowing who to exit to, you've got different avenues. You're not just going to be stuck with one. And then also, we always try to work out how is this industry going to evolve over the 10-year thing. We're going to hold it for 5 years. You're going to come want to buy it. How does it look like for you? Year 5 onwards, you know what I mean? So it is ultimately, I think, a stock picking game, an industry picking game, and you're making very much long-term bets, And as you sit here today, we think Look, exits are still very much challenging. It's a proper buyer's environment. So it's great if you've got a fund. So we like it, you know, the delistings, we did a delisting, a big one last year as well. But I think, yeah, you've got to navigate very carefully. But I think first rule, make sure you're buying a proper business that's quality to someone, you know.
Mike, anything to add to that one?
When it comes to unlisted, there's two big opportunities to make a good return on an investment. The first one is the price you pay. So in an environment where liquidity is at a premium, if you can, in the secondary markets, get good opportunities to buy at a discounted value, it's going to pay off in the future. And the second point is when you exit. Now, currently, it's a very difficult environment, and the bulk of exits that we are seeing is, and this is globally, is through private trade sales. So it's really crucial to understand what you want to do. In terms of an exit, it is changing over time. You know, the IPO route, we also were part of the Consol deal. The other one that comes to mind was Waco. The day before it was going to be listed, they do the scaffolding for the bridges over the highway. There's a gust of wind, scaffolding fell down and killed somebody, and they had to pull the listing because that was not the environment to do it. So it really is crucial, you know, to understand how long you can and can you extend it. And when you are seeing liquidity events coming in future, to plan them a long time in advance. So one of the things that we really apply our minds to, because I've been in a liquidity squeeze a couple of times in my career, is to plan ahead, because when you've got these unlisted exposures, it's multi-year programs to get out of them. And the last thing you want to do is be in that situation where you're giving somebody a great return in the future because you have to heavily discount your assets for the sake of exit.
Benjamin, you've heard from our local colleagues here, and they talk about a very difficult environment for exiting, etc. The global environment, similar, dissimilar? Obviously, it's been challenging too, but I don't think quite as challenging as it has been here.
It's definitely similar. I mean, if we look at last year's activity and also going into this year, I think M&A markets and private equity markets in terms of transaction volume is down roughly 20-30%. And this is not so dramatic because if you think about, we're coming also from a very high level in 2020 and 2021, but what we see now, and this is very similar to what we saw in 2009, and comes a bit back to the point that I mentioned before. In an uncertain environment, there's a clear flight to quality. There's a clear flight to things that are easy to understand, that are less cyclical, what I mentioned before. But this also drives prices up. And if too many people cruising around the same deal, then we know what happens, right? There's the bidding war, and then you quickly overpay. When it comes to an exit in that environment, I mean, it's much easier to sell a healthcare company than an industrial company at the moment. Probably also the industrial numbers don't look great from the last year, so it's double tough. And I mean, going into a deal and knowing when you sign who the potential buyers are is such an important key element that became so much more important over the last couple of years. I think 20 years ago, people more went into a deal. It was all about the transformation. And talking about transformation, I think when we talk about transformation, we always think like growing something, make it bigger, right? That's make it better in a way. But I think when it comes to exit, it's very important to make it cleaner, to make it more transparent, to make it easy to understand, to have a story that I always love to say, like you have a one-pager, not more. And this is how you go out. If that doesn't fly, and you have on that one-pager already like 3 questions from the other party, it's going to be a very, very exhausting process, and sometimes not even one that finds an exit. And then when you are burned, when you went to market, and it fails, then you probably have to hold the asset for another 2 years because you can't go 6 months later in the market again because it just burned a bit then.
So in the discussion we have thus far, 3 things have struck me already. The first one is how critical good due diligences are, and that's why you each come from large organizations with big-sized teams. You cock that up, you're in trouble. Second is the pricing paid, critical. Because, especially now, I think you need to almost get that extra discount to take account of the fact that exits might be difficult. And then thirdly, sizing this portfolio because of liquidity and, one's exposure to the asset class needs to be an appropriate level. I don't know if anyone's got kind of thoughts as to, a retail investor or an institutional investor, what might be kind of a maximum one would put into, private equity. And then secondly, just currently for all three of you, raising assets in this environment, how is that going? What is the market like? How receptive is this or other audiences to yourself, to your pitch? Maybe Mike, if you want to start.
So the first thing you really need to keep in mind is private equity is not the only illiquid that's competing for space. There's unlisted credit. Fortunately, it's self-liquidating, but it does create a liquidity waterfall in your portfolio that you've got to be mindful of. There's direct property, there's infrastructure. So whenever you think about sizing of an illiquid, you've got to think about them in concert and holistically. And essentially, what is the circumstances for the different types of investments? Where are they in the market cycle? There's a lot of sentiment in the market. And how do you see the waterfall and the cascading of getting out of it? We've tended to have relatively low exposures in our portfolios. So typically, a private equity exposure in a portfolio would be 2.5%, because you've got to add the other stuff. So that's an important thing to bear in mind. And sometimes the regulator surprises you. So the comment earlier was made that we're a well-regulated environment. We're very, very well-regulated. We, in fact, probably too regulated, and the regulations don't necessarily speak to each other. So you've also got to be mindful that regulation will come out that contradicts each other. You've got a presidential focus on let's do infrastructure investment at the same time that you say, okay, well, you can take up to half your assets offshore. So my personal view is you've got to be very circumspect. You've got to understand the nature of the liability you're solving for and whether it makes sense. So, you can look at it from an asset, a pricing and return perspective, but you also need to have a view of when is somebody going to come knocking on the door to say, it's time for me to take my money and leave. So those are all the aspects that you need to take in mind. So not just the opportunity, think about the other illiquids in the portfolio and understand what you're solving for. If somebody can stick in the portfolio for the next 20, 30 years, if you've got an annuity stream, and you've got a well-defined cash flow profile, you can live with more liquidity. If you've got a member choice environment where you've got a quarter of bad performance and you're going to be kicked out the door, then you've got to make sure that you can pay your dues when they come knocking. So it's a lot of the factors that you need to think. It's almost a concert. You're the conductor in a concert as portfolio managers, and you need to think of all the factors, both the pros and cons. And in my experience in the industry, there's always going to be pros and cons.
Giovanni, anything about that you'd like to challenge or agree with or disagree with?
No. I would love to chat now. No, I agree with all of that, Glenn. I mean, I was just reflecting on this, on your other question of just raising money in this market. What the key, for me, I think it's for all of us just to encourage asset owners to get into alternative assets. And I'll talk about Old Mutual's experience. Old Mutual, they're like first mover into the space. They've been, 25 years plus into alternative assets, and today, our alternative investors business is more than 100 billion. And it's worked incredibly well. Diversified the client, but from a return perspective compared to the listed side. So for me, it's almost you want to add it on. Add it on. Not only are you diversifying, but just your return, access to potentially higher returns. For me, that's the big tick. And then I think the other big message to investors out there is, and I think that's just a South African phenomenon. South Africa is quite resilient. Our businesses, again, you must just go up north. Whenever you come back and you always just, Actually, this is an incredible place to be.
Depends how far north you're going. As far north as Benjamin or just kind of the Sahara?
Just before you get to the Mediterranean. Anyways, my point being, that is a story that you must keep on telling to people. Is you can still access return here. We've got incredible institutions, and really incredible, entrepreneurs that you want to work with. And we saw it in COVID how our businesses bounced back quite quickly. As Almicho, we employ about 20,000 people across. So there's quite a burden of responsibility. And for me, the ability to steer businesses in times of crisis, in times of volatility, is just a strong feature. A strong feature. And if we're not going to do it, who's going to back these private businesses? This is what we need for job creation, ultimately.
Shimon, when I think of South Africa, absolutely we're resilient and we survive, but we've become a value player. Our currency's cheap and our stock market's cheap and everything's cheap, but there's not a lot of growth. So it's in a difficult environment. So I do hear your point, but it's not easy. But if I can move on to just a little bit, the name of the game of the last 18 months has been very heightened inflation across the globe, and with it interest rates going higher. We have a SARB meeting soon, we have a Fed meeting I think today. There's a possibility that rates go even further. Certainly in South Africa that almost seems to be. With interest rates this high, with cash earning, 5% just on US dollar, how does that compete? That hurdle rate is now a lot higher than the zero of just a year or two ago. How does one think about this space now?
Obviously it has an effect, right? And last year was a record year in terms of inflation, in terms of how fast interest rates went up. I think the good news is that the increasing interest rates, they had an effect, right? Stupid situation would be we would have increased interest rates and inflation wouldn't have come down. It's slowly, and I think what we all have to realize is that the 2% inflation target thing that I don't even know who came up with it because there's no scientific evidence behind it, that we just have to get used to an environment where we have like a 3-4% inflation environment. I think we can live with that. And the debt levels, the government debt levels that we see, probably is a good thing to have that kind of inflation because we haven't had it for a long time. But it means for companies, you have to adjust, you have to adopt. And when I think back last year, Q2 maybe, we had supply chain issues. We had the highest energy costs. We had 10 times logistic costs to bring a container from Europe to Asia or to US or Africa. That was a mouthful of problems, and many of them went away. But inflation we have, and what does inflation and higher interest rate now mean for private equity? It means probably lower returns. But coming down from an 18 to 20% level to a 15 to 16% level, that wouldn't be the end of the world, right? And that there are now some government bonds where you get like 4, 5%, 6%. It was not, we couldn't have believed that a couple of years ago. Great, then you have a portfolio where you also earn money on your fixed income again. So I think that's good, but I don't want to see a doom scenario where people now say like, oh, private equity, this is such a risk. And yes, financing costs went up 300-400 basis points maybe, but they came from nothing. And when you look at the long-term rates, we're still very cheap there. I think you have to be just, again, more careful in your structuring, in your financing structure, in sourcing the business. And maybe the business have to deliver more from within the transformation in the business, from the value creation that you achieve there. And the leverage effect, the positive one that we all like on top, is maybe less than in that context, right? But I'm not too worried, in all honesty, and especially if you like in the right segments, right bottom-up research that you do in your companies, I think there's still a lot to earn.
So I'm trying to do my job as a good chair. I'm having a look here. Our time has expired. I didn't see any questions coming through. So I take it you guys have done a fantastic job in answering. Is there anything in closing, 30 seconds, start with you, Benjamin, anything you want to say as a parting comment?
When we talked about fundraising, we all love to think that we are so contrarian and that we can time the market and everything. Let's not try to do that. But please join me in believing that those environments or those years where we have so much uncertainty are the best to invest in private assets, private equity. But it's very difficult because, some institutions are constrained by the denominator effect or by some allocation issues. But it would be a shame to miss now that window of the next 1 or 2, 3 years, because those vintages are going to be good ones if you look at historic data, and I will provide more on that later.
We look forward to your panel, your discussion later. Chumani, any closing remarks?
Yeah, maybe my closing is, I think again, for me, we've got to continue this push into alternatives, / private equity. And, I agree with you. People must invest, across vintages. That's how you get the full benefit of being in private equity. But I think there's just one caveat there, which we don't talk about, but you've got to find the right managers. Like, experience counts with everything. It is a difficult terrain to navigate.
Thank you, Mike.
People are sentimental creatures, and they...
Not this audience, but other.
I'm a sentimental creature. My ex-wife might disagree, but that's another conversation. But on the back of sentiment and emotion, there's overreaction. And overreaction means that when people don't want to invest, is the time to invest. And I've seen that over and over again in my career. I hear the refrain, but this time it's different. The world's going to hell. It's not going to cover, and people are resilient. So that old value saying, the time to invest is when there's blood on the streets.
Well, there certainly seems to be a lot of blood in the streets, it would appear. Thank you to our panelists. Great discussion, and I hope you enjoyed.